talk to you, David, about what you think is happening to this market. You think that we probably are due for some sort of a correction. Welcome.
Yes. Well, I think it's pretty obvious the top's in. The market's been chopping sideways for 6 months now across 2100 way back in February 13. I think it's just waiting for the knee-jerk bulls and the robo-traders and the dip buyers to finally capitulate, because the larger picture has nothing to do with the jobs report tomorrow or even the September decision by the Fed. It has to do with the fact that the world economy, including the U.S., is heading into what is clearly going to be an epochal deflation, the likes of which we have never experienced in modern times, kind of the flip side of 20 years worth of massive credit expansion, almost a debt supernova worldwide that's taken total debt outstanding from about 40 trillion around the world in 1995 to 200 trillion today. The result of that was to massively lever up the household sector in the developed world, so they're at peak debt. They're not going to spend our way out of the pickle that we're in today. The effect of that was to take the EM world, the emerging market world, with China in the lead, to peak capacity. We have had such massive overinvestment in shipping and mining and oil and gas and manufacturing and distribution that we are now stuck with a massive overcapacity and huge pressure, downward pressure on prices and margins and profit.
David, let me ask you this.
I think all of that is the backdrop in which the market is kind of churning and chopping today. But, this commodity deflation isn't a temporary thing. It's not even some kind of super cycle. It's the end of the central bank led or enabled bubble that's now going to reverse.
David, a lot of the guests that come on the show, the traders, analysts that I speak to, wouldn't dispute the scenario that you're setting up. But the question that we have for you is, what would be the catalyst that's going to trigger this? You mentioned what we're seeing in commodities. We've seen a little bit of a sell-off in the markets as a result of that. What will be the specific catalyst that maybe gets the market to wake up to this?
Well, I think the catalyst has already happened. It's China. China is falling apart. I mean, China is the most lunatic pyramid of credit and speculation in human history, and capital is now fleeing the swaying towers of the China Ponzi. They've lost $800 billion in hot money or capital outflows in the last year or year and a half. They're desperate as to what to do about it. The fact that they're sending out the paddy wagons and propaganda to try to hold up this huge bubble in the stock market is just one indicator of the desperation at work there.
Right.
And remember, the whole global economy since 2008 has been driven forward by this massive investment and construction and borrowing spree in China. And the point that I'm making is that it's over. The Bank of China is now going to be actually forced to shrink its money supply.
David, you use a great word there when you say it's over. You are saying that it's over for the Bank of China. The market seems to think that that crash or the brief correction that we saw within the Chinese stock market is over, and that's why there's more confidence back in the markets. When does the stock market, when do investors wake up to what's happening in China and potentially realize the severity of this and that another shoe could drop?
Well, I mean, some have awakened to that already. Others, will be bludgeoned some morning when the market there drops another 7 or 8 points. I think this is totally artificial. I think the idea that the overlords in Beijing have complete control of their economy is a great myth that's been propagated by Wall Street. The fact is there's 90 million trading accounts in China. There are more trading accounts in China than the population of Japan, Korea, and Thailand combined. So if you think with a few paddy wagons and some visible arrests and some, nasty warnings that we're coming after the shorts, can control 90 million people who are in over their head in margin. And remember, the margin growth there was crazy. 100 billion a year ago, $1 trillion at the peak a month ago. that kind of thing is not sustainable. It's, a huge disaster waiting to happen.
Well, let me ask you this. Sometimes we could argue that artificial isn't necessarily a bad thing. If you think the action that the Fed has taken, and some guests have come on this show and said the artificial propping up of the market is what the Fed has done here, it hasn't actually paid off to be a bad thing for investors. The artificial propping up, if you assume that to be true, has been good.
Well, it was good in the year 1998 to 2000 until it wasn't, and then the investors got blown away in the dot-com crash for about $7 trillion worth. It was good during the housing boom and the mortgage bubble until it wasn't, and then came the fall of 2008, and investors got blown away for 5 or 10 trillion more. So, of course, these things work until they don't. They're artificial. They defy the laws of sound finance. And sooner or later, when the last sucker buys the last overvalued asset, the thing begins to tip over. Now, today, the Fed finally admits, after 78 months, that zero interest rates have to end. It's crazy. It has nothing to do with consumer inflation or even the GDP growth rate of the economy. It has to do with fundamental financial logic. They're creating bubbles when they make overnight money free, because it just fuels massive speculation and carry trades. They know that. I think they're going to raise interest rates, and once they start normalizing, there's no turning back. If they try another QE, they'll scare the hell out of everybody in the markets. And so, therefore, they're marching in the opposite direction of the last 20 years. The same is true with the Bank of China, and I have to emphasize that.
David,
the same is true, actually, with the Bank of Japan. They've shot their wad. It's failed. And I think what we're seeing is the beginning evidence that the central bank-driven credit economy is over, and we're in a new era, which I call the era of epochal deflation.
Okay. David Stockman, one final question to you before I let you go. Very big primetime presidential debate for the Republican Party tonight. You were a member of the party yourself. You are. Any thoughts on what we're going to see tonight? Anyone in particular you're rooting for?
No, I'm not going to watch it. If I wanted to see some clowns performing, I would go to the circus.